Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is a bi-weekly review and preview, so every other week, of the market's key events and trading opportunities. Whilst I just let you have a look at the disclaimers, just a brief background really as to the goals for this webinar and the idea behind the webinar. We think markets are primarily driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term fundamentals or short-term themes that increase and decrease in importance over time. So this week we'll look at a review. We'll review some of the key events of last week. We think these are important for the drivers, the longer term drivers around that dollar strength that we've been talking about over the last few weeks. And we'll check out the DXY, the dollar chart, and also the S&P 500 chart. We'll then do an educational point, so 101 on central banks and doves and hawks and the ideas behind this, and then look at the ECB meeting in detail, which is obviously coming up tomorrow, and then look on the technical side at the euro dollar, the world's most popular currency major. We'll then also review with this central bank theme in mind, we'll review the RBA, this week's RBA meeting, and have a look at the Aussie dollar, and also last week's Bank of Canada meeting and look at the dollar CAD because potentially these are pretty impactful on those currencies going forward. We'll then look at the other major event of the week, the US CPI data due on Friday, and if we have time, hopefully we'll look at a key currency pair in the news at the moment, dollar yen hitting 20-year highs again, and also we'll look at sterling dollar as well with the news, the UK news around the UK Prime Minister Johnson this week and his vote of no confidence, which he survived. Firstly, then, as I said, we'll just review quickly what's been happening in markets. They continue to be choppy with this real ongoing push-pull, if you like, between inflation worries on the one side and slowing growth on the other. And we've really been pivoting between those two a lot recently. And regarding bond yields, which is obviously a prime driver of markets at the moment, really after the consolidation lower in US Treasury yields, so that's the most important benchmark for the price of global money, the dollar, that consolidation really proved quite modest from the top earlier in the month, and yields, US Treasury yields have again pushed higher, touching 3% again on that 10-year US Treasury yield, the widely watched benchmark for global yields. Just recapping on the data then, the most important probably was last Friday's non-farm payroll. We saw solid job gains despite the tight labour market. On this chart, you can see the print there. The headline print was 390,000, beat expectations of 320,000 with only small negative revisions over the previous 2 months. Quite like this chart because it really takes out those extreme months that we've seen over the last couple of years or so post-pandemic. So the massive job losses and then the big job gains on the reopening, we stripped out that, and you can see really that 390,000 job gains is actually persistently strong job growth, and is really quite unusually strong, especially when you compare it back to, say, 2010 up to 2020, so the last decade or so, where you saw job gains around the 100 to 400,000 mark only. So persistently strong job gains, and also just another chart there. If you don't strip out those gains, then the sharp price, the sharp job gains and losses that we've seen, then you do get this tricky chart that you can read. So much more interesting there when you strip those out. Two key points really from that data. The wage growth obviously was a focus due to its impact on inflation, and it remains relatively modest at 0.3% month on month, so below the estimate of 0.4, and the year on year was 5.2 below the previous 5.5. On this chart, really relative to last year, the pace has dropped from roughly 6% to now roughly 4.5% if you adjust the data to hold industry composition constant. So really that downtrend or slowing trend really in wage growth is quite encouraging for many, and that dreaded and much talked about wage growth spiral is potentially yet to happen. Also, the labour force participation, that ticked up very slightly, which tells us that people are returning to work. There is some concern actually about a tighter jobs market, of course, going forward, which means more upward pressure potentially on wages, which is likely to keep inflation stickier in the US than in other job markets. In turn, really, this supports the view that the Federal Reserve will continue to be more aggressive in raising interest rates than some other central banks, which will keep the dollar supported potentially over the next few months. A key factor then for potentially underpinning dollar strength and dollar support especially. Other data last week worth touching upon: the ISM manufacturing data. That's one key data point which really helped those yields push back higher. And that showed a surprising rise to 56.1 from 55.4. Remember that above 50, that denotes expansion, while below 50 really signals contraction. So 56.1, really healthy level still. There have been mixed regional indices which pointed to the prospect of a dip in these numbers, but instead new orders rose quite nicely. One other jobs data point worth looking at, we think, as well, is the JOLTS data. That is basically on job openings in the US, and that was slightly lower in April, but remains at record highs or very close to record highs, which really points to this very high labour demand clearly outpacing labour supply. And quite an interesting stat, we think there are still nearly around 2 job vacancies for every unemployed American. To put that into context, in the UK, there's 1 vacancy for every unemployed Briton, and that's deemed as quite a tight labour market. And in Germany, there are just 0.4 vacancies for every unemployed German. Also, just something else to highlight from last week. June the 1st saw the de facto start of Fed balance sheet reduction or quantitative tightening. Complex term potentially, but what does that mean? So quantitative tightening is basically the opposite of quantitative easing, which is obviously what we've seen over the last few years. So it basically means the Fed is reducing its balance sheet and a way to reduce the money supply floating around in the economy. So the Fed, essentially, they let their existing maturities pay off and they don't reinvest the proceeds and burn the cash. And what they're doing in treasuries and their mortgage-backed securities, around just under 50 billion worth is allowed to mature per month, and that will be increasing to 95 billion in September. So its main impact in financial markets is likely to be a move higher in real yields, or those inflation-adjusted yields, which in turn, that will make stocks somewhat less attractive. Also, Treasury market liquidity, so that bond market liquidity will come under scrutiny as the Fed takes essentially a step back, and ordinarily this is expected to provide some support for the US dollar. As we've said, it's also a headwind potentially for stocks, for risky assets as valuations potentially get impacted. And basically, if quantitative tightening continues as expected, the Fed's balance sheet, and we can see here, then it will come down, it will be shrunk, it will reduce by some $1.5 trillion by the end of next year. And economists reckon that is the equivalent to another 75 basis points of tightening. So really impactful, and something to bear in mind here with this QT quantitative tightening, taking money out of the system and potentially impacting stocks even more than we've seen if it carries on as it's meant to. And we see that even that $95 billion increase in the maturity of these treasuries and mortgage-backed securities, which takes liquidity out of the system, which has certainly been supporting valuations in risky assets in stocks over the last few years. We think also probably interesting to note, just looking at the Fed, obviously next week, a key meeting where we also get the dot plot, an updated dot plot, and potentially the signs of still the 3% sort of marker for the end rate for the Fed funds rate. Interestingly, we've had this idea of a pause in the, or potentially the Fed looking, reassessing the data over the summer. So we get two 50 basis point hikes in June and July. Here I've just pulled up the CME Fed Watch Group, the CME Fed Watch Tool. We've looked at this before in other webinars. If you guys didn't attend those, then really a really good tool, really analyzes the probability of FOMC rates for the upcoming Fed meetings, basically using the Fed funds future. And you can really visualize both current and historical probabilities of various rate change outcomes for a given meeting date. So we can see, as I said, 15th of June, that next meeting next week, nailed on 50 basis point move, you can see. And then July as well, pretty much nailed on again, another 50 basis point move. But after that, as I said, this potential pause, the idea anyway of a pause the Fed might take, or at least going down to 25 basis points. Interestingly, the market really has changed that viewpoint. There was Vice President Brainard who last week said she doesn't really want that pause and thinks the Fed's still, quote, I think, still have a lot of work to do to get inflation down to our 2% target. And you can see, as I said, so the 21st of September meeting, that 50 basis point move, now 60%, really 60%, sort of doubling really from last week here, when it was around 31%, and that idea of a pause. So the market's really not thinking that we do get that pause at all now, taking it up to 60%, above 60%. One interesting thing I should add here, the 70% marker, a lot of people use that as a basis for the Fed's benchmark. Once market pricing goes above that 70% level, then it's pretty much nailed on that the Fed will follow through with how the market has priced that meeting. So we're getting close to that benchmark sort of level, which is generally been used in the past, 70% as a marker to pretty much expect that move to happen. But as I've highlighted there, even last week, that jump nearly doubling from 30% to 60% of a 50 basis point move then on the September 21st meeting. Ultimately, the trend in data surprises in the US really has turned probably more quickly than many expect. Even when some reports, obviously the labor report is still fairly buoyant, but longer term, potentially, as long as the Fed is withdrawing that liquidity through quantitative tightening that we just mentioned, global activity momentum is slowing, and there is potentially this risk of equity sentiment selling, capitulation, or at least it remains highly uncertain. Then for the dollar, really, we think it's probably tough to be structurally negative. If we just look at the chart, we can see obviously that we've come off those 20-year highs above 105. This is the DXY chart. We've got that resistance zone. So the resistance zone that we've talked about quite a lot, 103.82 is the January 2017 high, and then 102.99. That's the pandemic March 2020 high. So coming off those 20-year highs, below that resistance zone now, which really was support, but now again is a major resistance zone. Support, well, we're sort of being supported quite nicely by the 50-day moving average around 101.88. We haven't really traded below that since around February. So really nice support here. And we've bounced off that a couple of times in recent sessions. And then below that, we have a long-term trend line from just above, well, from way back well, the October 2021, trendline support. The trendline long-term support from actually, as I said, March 2002. If we go back to the monthly there, you can see there from there dropping down, and it just tacks in at around just above 100. So that's sort of major support below that 50-day moving average. Much will depend, of course, potentially on the US CPI figures that we'll go through a bit later, and then also obviously the Fed meeting next week. Also then just looking, as we mentioned, just looking at the S&P 500. Again, technically, well, we're trading around now the February low at 41.14. Really sort of consolidating around there after this move up from those lows around 3815 and the fib level, the 38.2 fib level, that is, of the March 2020 pandemic low and the January high, bounced off there, and then consolidating, as I've said, around the February low at 4114. Resistance above then the 23.6 fib level of the around 4198, and then above there is the light blue line, the 50-day moving average at 4233. If we happen to move lower, then we've got support at last week's low around where are we, around 4074. That's initial support, and then we get that sort of short-term trendline support around 4,000. I did interestingly wonder whether, if this is bullish consolidation in this move up from these lows, and you've got a sort of very small double bottom reversal pattern there, then potentially you've got a measured move from that neckline. If we do break higher, then a 300-point move would take us up to 4,400. But we really need to break above that last week's low, last week's high, and then that fib level to push above potentially into the sort of 4,300, 4,400 level. Again, much depends on the Fed and what they signal potentially in those dot plots, and if they signal that rates are going to above 3%, that may obviously hinder risky assets. Okay, let's now, we'll just go to our educational point, our 101, which we think is worth looking at potentially. Or as we've said, central banks is obviously key at the moment. A lot of headlines around what they're doing, and also this idea around hawks and doves. So the importance of central bankers' deeds and words, as I've said, in advanced economies has really increased significantly over the past 2 decades. And this is evident from the way in which markets directly react to monetary policy changes, as well as expected future stances of central banks. And for the ECB, since its creation, the bank has traditionally presented itself as a consensual institution by carefully minimizing the display of disagreement amongst its members, and really asserting that only euro area economic conditions are considered in policy deliberations. Of course, appearances are often deceptive, and the ECB is pretty much quite a political institution where important political battles do play out. So what is a central bank hawk or a dove? So in general, hawks, what are hawks? They're central bankers who are more concerned with potential recession from higher inflation than with economic growth. So they tend to want tighter monetary policy to temper that inflation and growth, so favor higher or at least an increase in interest rates. The transition mechanism then, as we've gone through a couple of weeks ago in one of the webinars, the transition mechanism sees that higher interest rates make borrowing less favorable or attractive for individuals and corporates. And this then leads to an increase in spending, lower demand, and price stability. On the flip side, the doves, they're more focused on stimulating economic growth and tend to want looser monetary policy to do this. So they're more worried with low unemployment and stimulating growth, so favor lower or at least a decrease in interest rates. So again, looking at that transition mechanism in basic economic terms, lower interest rates, they encourage borrowing by corporates and individuals, which in turn encourages an increase in spending and higher demand. So regarding FX markets and those implications, then generally a more hawkish view expressed by a central banker would highlight a potential for higher interest rate environment for that country. This would then favor an appreciation, so a rise in the currency, and that's obviously what we've seen with euro dollar coming off those lows, 103.48 more recently. A dovish view, on the other hand, expressed by a central banker, that would point to a possible lowering of interest rates and a likely depreciation or a fall of the currency. So essentially, the hawkish or dovish views of central bankers can have a direct impact on currency rates. And it seems it's certainly noticeable that in the last few months, as the battle between combating rampant and sticky inflation versus that slowing growth conundrum that we've mentioned at the start of the webinar, as that plays out, so the hawks and the doves have become more vocal. And we've got this slide here, really a guide to European central bankers' hawkish or dovish leanings, which should provide really an insight as to whether their expressed views are more or less dovish or hawkish than would be expected. There is a lot of research has been done on this, on hawks and doves, but it's really limited to the FOMC and the Bank of England MPC. And this is because the ECB doesn't provide voting records or the total transcript of the Governing Council meetings. So it only provides a general account through its minutes. And it's also worth remembering that very few central bankers actually describe themselves as a hawk or a dove. So it's only through speeches that the market determines that bias. Also worth bearing in mind that some members, they will tend to stick to always being hawkish or dovish, while others tend to be more flexible in their views and just switching from time to time. So that then can be a market moving event when someone dovish, for example, changes tack and becomes potentially more hawkish. So regarding the ECB specifically, you can see on the slide, so the hawkish members of the Governing Council generally, they're at the bottom of this slide, and then rising up to the top, they're the most dovish. And we can see, we've mentioned it before, that generally Northern European countries, Austria, Netherlands, Germany, you can see they're the most hawkish members, whereas Southern European countries generally are more dovish, and they're at the top of the slide. So recently, what can we take from this? Well, Holtzmann, for example, the current head of the Austrian central bank and a known hawk. So he noted that last week's inflation, Eurozone inflation print, really backs the need for that 50 basis point hike, which he thinks would send a necessary clear signal that the ECB is serious about fighting inflation, and it would also help support the euro. On the dovish side, on the flip side, we've had Chief Economist Philip Lane. He spelled out a roadmap for monetary policy normalization, but that entails smaller 25 basis point hikes in July and September. And we also had, for example, De Cos from Spain, the governor of the Bank of Spain. He expects to eliminate policy accommodation in a very gradual manner, and that really is the key word for next week's meeting. So what to expect from that meeting on Thursday, this week's meeting tomorrow. Well, the markets expect the bank to announce the end of large-scale asset purchases in early July, and then signal clearly that rates will rise at its next meeting on July 21st. And that would be the first time in a decade. You can see this Bloomberg chart with the purple, the lower line being current ECB rates compared to the Fed and the Bank of England. So a rate rise, yes, the first, potentially the first time in a decade, and markets really expecting a clear signal for its next meeting in July. Of course, that attempt by the dovish wing of the ECB at reclaiming control, if you like, over the narrative, that did include President Christine Lagarde as well, and she really pointed to the end of negative rates in September. But then this was, of course, slightly upended by that higher than anticipated inflation prints last week, with the core printing at the headline printing at 8.1%, and really that isn't expected to peak until late summer, with German inflation especially potentially being double digit. So as I mentioned, the key question really we think for markets is this gradual idea, gradualism. Panetta, a well-known dove, he recently said, he called it small steps in a dark room, I think. So is that the right approach? You also had Villeroy, so a neutral member of the governing council, said only last week inflation is not only too high but also too broad. Fair enough, but then this requires normalization and not tightening. And that sort of suggests he's also against an aggressive rate hike, a 50 basis point rate hike. But of course, for the dovish side, and even for the neutrals, perhaps that gradualism goes out the window if inflation really turns ugly and expectations become unanchored. Focus will also be on the staff projections, the ECB staff forecasts, with higher inflation forecasts, of course, and then lower growth ones. The economy is just about holding up when looking at business sentiment indicators, even as consumer confidence is at record lows. Interestingly as well, the decision to go ahead with that partial Russian oil ban will weigh, though the Saudi news to increase oil production potentially helps, as it will alleviate some of the need for tightening financial conditions, while also easing European import prices. So interesting, we think we may focus on those inflation forecasts for further out, so for 2024, as a guide to where the ECB is heading. Importantly for markets, what are they pricing? What are money markets and swaps pricing in the market for this meeting? Well, they currently price in around 37 basis points for the July meeting. So that's, if you think about it, that's a 50% chance of a 50 basis point move at the next meeting. And there's around 100 basis points priced in for the October meeting. I think for year end now, we're up to around 135 basis points of rate hikes. And if you think there are 4 meetings left after this week's, so this really does suggest markets are really looking for a bigger 50 basis point hike, either in July, September, or October. I guess the question is, do they go earlier? Do they go certainly, we don't think they go tomorrow. Very little chance of that. But do they go 50 next month is the critical issue really for markets. Surely we think the damage to the credibility of both Christine Lagarde, the president, and also chief economist Lane will probably be too much, because they essentially set out that roadmap, that base case for 25 basis point rate hikes in July and September. So to go 50 in July really would damage their credibility, you would like to think. Of course, there is a lot of time till that meeting, really a few weeks yet, and another inflation print. And as we say, if that turns ugly, maybe then markets really will demand a bigger hike. But at least for the meeting, markets really expecting that Christine Lagarde, President Lagarde, really does keep that 50 basis point move on the table for July. Technically, just looking at the euro dollar chart, if I just pull that up for you. So here we are. We can see really after last week's fall on Wednesday, that found support at the pandemic low from March 2020 at 106.36 that we talked a lot about. And really, we've been oscillating just above there for quite some time now, around 10 days really of sideways trading, really waiting for tomorrow's big ECB meeting. Upside really capped by the 108 level there, the 108.05 level from the March low. There's also that descending trend line resistance there, which tallies around the 108 level as well. So really trapped between the 108 level and the 106.36 support. Really pivotal levels if we do break higher. If Lagarde does mention the 50 basis points for sure, then potentially we break above 108. We push above to, we have the 100-day moving average in the grey line there, around 109.39 will be a level for Euro bulls for sure. Obviously, if Christine Lagarde is more cautious, then potentially we push against that support, so 106.36, and that really is in line with the long-term dominant downtrend. We break 106.36, then we go back towards pushing down towards 105, and then obviously the sort of mid 103 level potentially. We do notice that 50-day SMA, 50-day simple moving average, which is that light blue line, which we've been trading just around really. We haven't pushed above there, similar to that DXY, haven't pushed above there since February. So quite worthwhile tracking that marker at the moment. That's at 106.96, so exactly pretty much where we're trading now. What's next? Let's look at, we mentioned some other central bank meetings which we think are quite important for their currencies going forward as a guide. So we had the RBA meet on Tuesday. They raised the cash rate by 50 basis points, fully unwinding the emergency cuts seen during the pandemic in 2020. The consensus view had been for a 40 basis point hike, with the market pricing in below that, actually around 30 basis points before the meeting. So definitely a surprise and kind of slightly out of character for a central bank that has always sort of seemed to characterize itself as on the dovish side of the Fed. So the RBA, they said in their statement, the economy is resilient and inflation is expected to increase further before dropping back towards a 2 to 3% range next year. And policymakers really expect to take further steps in the process of normalizing monetary conditions over the months ahead, and future rate increases will be guided by inflation and labour market data. Inflation, well, where is that at the moment? Well, that jumped from below target to above target, with Q1 CPI surprising to the upside at 5.1%. And the jobless rate, that fell to the lowest level since 1974 at 3.9%. We think it's important critically then to watch this data. The inflation data is released only quarterly, important to note, so we won't get any new insights into how this is really shaping up until late July when Q2 inflation data is released. The wage price index, which the RBA looks at for sure, the Q2 2022 wage price index, that's not released until even later, so mid-August. So really until that time, especially late July, really markets will be focusing on the labour market and any clues there for rate hikes going forward. But essentially the RBA, like other central banks, is front-loading its interest rate hikes, trying to return net rates to a neutral setting quite quickly. We note again the FOMC and the Bank of Canada, they did a 25 basis point hike and then 50s. RBNZ, they did 2 25 basis point hikes and then moved to 50s. So bigger increases earlier on. As an aside, really, it's generally better, of course, to move decisively in the early stages of the cycle when it's clear rates are well below neutral than later in the cycle when obviously there's a risk that policy moves too quickly into contractionary territory, and that's potentially what the market is fearing for the Fed. For the RBA then, this early decisive move, well, it does send that signal that the bank is committed to its inflation objective and will likely impact inflationary expectations in the community. And certainly that would be welcome, as the current inflation rate and forecast by the end of 2022 are actually for 5.9% for the headline. And that compares, if you look at the Fed's PCE inflation gauge, that's a 4.3%. So inflation really is most likely not peaked in Australia, potentially due to the recent energy price rises and for rents. But looking at the market, how they're pricing, they're very aggressive for rate hikes going forward in Australia. And it's interesting that sort of the Aussie dollar has been struggling since the RBA hike. But then that's to do with risk sentiment globally, and also really that sort of cloudy China growth outlook, which remains. Further out, we think probably global growth risks next year may tilt towards a shorter RBA hiking cycle, and that's probably what you've seen in recent price action in Aussie dollar. We've just got the chart up here that you can see. So the rebound has been strong since bottoming out below the key 70 level in mid-May. I think traders were slightly hesitant that the weekly close below that important psychological level didn't foresee more downside, but instead we had rising bets on the RBA tightening cycle, and that's seen Australian yields outpace US Treasury yields to new cycle highs. We've also had slightly better global risk sentiment, obviously, since mid-May, especially slight easing of those China COVID restrictions and rising commodity prices. So they've all helped support the cyclical commodity-sensitive Australian dollar. Obviously, up to this point, up to sort of the fib level that we marked on here, around 71.55. We're now trading around quite a few long-term SMAs, long-term simple moving averages. The 200-day, you can see the black lines at 72.54, the 100-day moving average at 72.28, and then the 50-day at 72.08. So really sort of consolidating around those levels and above that support level, the fib level, 71.55. If we do go higher, then we see potentially this March spike high at 74.41 as a level for bulls, potentially if we do push higher in this nice bullish channel. Support, as I say, is that 71.55 level, and then if we do break below that potentially, and this week's low as well, then we move back, break outside that channel, and then towards sort of 71. The next fib level, 23.6 fib level, is at 70.36, potentially moving back towards that key psychological 70 level. Also worth reviewing, we think, is the Bank of Canada meeting. That was from last week. Really important, we think, because it was a hawkish hike, and the statement that they released, the Bank of Canada, really didn't disappoint. So they raised rates as expected by 50 basis points to 1.5%, but they also continued with quantitative tightening, and the message was pretty clear cut. So inflation is broadening with measures of underlying inflation rising. Indeed, 70%, I think, of the CPI categories are printing above 3%. And CPI in April, that reached a higher than expected 6.8%. So the Bank of Canada expects it to move even higher in the near term, which means it's moving further above target. Potentially, the global economy will slow down, but growth in Canada in the first quarter was solid, above 3%, and the Bank of Canada expects this to continue in Q2 on consumer spending and exports. And job vacancies are also elevated. Wage growth is rising across sectors. So essentially, the economy is running pretty hot. And even after a couple of 50 basis point hikes, policymakers are warning that more hikes are coming and are prepared. The bank is prepared to act more forcefully, the phrase they use, to get inflation back on track. The superlative used there, really, that's a change from before, and is in fact an upgrade in language from the prior, where they just said forcefully on rates. And this kind of tweak sort of really, we think, does matter. It is important, potentially signals the risk of more 50 basis point hikes in July and September, or potentially perhaps a 75 basis point hike, especially if oil prices go higher, commodity prices go higher, potentially pushing inflation further north again. The July meeting for Bank of Canada, we get a monetary policy report, so we get updated forecasts. So really underpinning, we think, Canadian dollar strength. The economy remains in excess demand and rates will need to rise further. And the Governing Council in the Bank of Canada is prepared to act. Over the medium term then, as we said, this should be CAD supportive. The Bank of Canada potentially is tilting even more hawkish than the Fed. And especially if the Fed do possibly take a bit of time to reassess economic data. Technically then, dollar CAD, well, you can see we topped out at 131 in mid-May, and this has fallen back on the soft dollar tone. We saw some consolidation around 128 before heavy selling took the major again down through 127 and through some long-term SMAs, some simple moving averages there, which now acts as resistance. We've got also the 61.8 retracement of the April-May rally that lies at 126.60, and along with probably the most widely watched SMA, the 200-day at 126.57. As I said, that now acts as resistance. We're currently trading around the next fib level, 78.6 at 125.46, but a full retracement potentially down to 124 does really look in play. And interestingly, we'll get the Friday, we'll see the Canada jobs data released. That is expected to see another decent rise on the cards, and unemployment is expected unchanged at a record low of 5.2%. So really probably keeping intact that bearish momentum, the bearish channel that we see in dollar CAD, and especially if you look at some of the crosses, Euro CAD, Sterling CAD, they're pushing on very long-term support levels, potentially breaking through those. I said very briefly we should look at the main major of the moment, dollar yen, sorry, which is obviously pushed through to fresh 2-decade highs, currently trading close to that 134 marker there now, 133.97. At a time really when the prospect of Fed tightening is the major driver of dollar strength, then it's really those the yen that has become the major victim in this higher yield environment, and it's those sharply widened differentials between the ultra dovish Bank of Japan really, and obviously then the more aggressive Fed that has pushed this sharp rise in dollar yen. Interestingly, even this morning we saw Bank of Japan Governor Kuroda firmly reiterate that no tightening plans are under discussion. I think he said that at the moment Bank of Japan must continue its support for the economy by continuing with current monetary easing. So really there's only one way at the moment for dollar yen. Obviously we do have the potential for more verbal intervention, but if you look at the history books, well, that tells us that unilateral efforts by the Ministry of Finance in Japan to intervene, they rarely have ever worked. I think they've done so around 7 times since the early 1970s, and it's probably only worked once in February 1994. Certainly joint efforts by the G7, they're more successful, but you have to think key here is the fact that the strong dollar policy has probably never been more needed and more wanted by US officials given high inflation. So technically, what can we say? Of course, Treasury yields, interestingly, US Treasury yields, which really do correlate strongly with dollar yen, they haven't pushed above their cycle highs actually, so they're only trading, the 10-year US Treasury is only trading around 3%. The high from May was around 1.12%, I think. So we haven't pushed above those like we have seen in other global bond yields and other global government bond yields especially. So potentially if we get towards that marker, then dollar yen has more upside potentially. We probably have to go, we have to go to the monthly chart to see the next key level, which is that February 02 level at 135.16, and it certainly feels like there's no stopping us till that level for sure. The October 1998 top above that is 136.89. Prices, of course, have entered overbought territory, but this really hasn't stopped this major from advancing in the past. And support is now around the previous May highs, around 131.34. Right, I think we've covered a lot in this webinar. We've really reviewed some of the last week's data, which are important for underpinning dollar strength. And then we've really looked in detail at the ECB meeting and the idea of hawks and doves. We hope you've enjoyed the webinar. Please register and tune in again for the next webinar in a couple of weeks. And stay safe trading out there, and all the best.